All right, we're on objective 11.2, but I actually missed one slide in 11.1, and I didn't feel like going back and making a whole nother video for just this one slide. So I wanted to throw it in here, the current portion of long-term debt. So I'm going to back over here to my accounting equation, and sometimes we may have a long-term note, but part of it is actually due in the short term. So it could be we have a 30-year mortgage or 30-year note. Whatever we're going to have to pay in the coming year needs to be recategorized and moved out of long-term liabilities into current liabilities. Because I just had that current ratio up here because you'll notice if they don't do that, that means the current liabilities are lower, which will make that current ratio go up. Okay. And it will make it look like they are doing much better than they really are. So there's certain ways to look at fraud. Like you'll never see them taking it out of long-term liabilities and pushing it up here because that's going to make the current ratio go down. Okay. You're not going to see them trying to take current assets and shove them down into long-term assets because that would make the current ratio go down as well. So you really only got to look in one direction on those because fraud wise, they're trying to make that current ratio go up. Okay? So any current portion of long-term debt has to be reclassified up into the current. All right. So the next thing we're going to talk about is basic payroll transactions. And this is always a fun section to talk about because, there's always debates about is Social Security going to be there when we retire? Maybe, maybe not. I don't know. I'm not worried about it. Even though I got 15 years before I retire, I'm not worried about that. Okay. So, how do companies actually account and record payroll? Okay. Payroll is also called employee compensation. It creates a liability for businesses, and it's a huge expense on most businesses' financial statements. Okay. It can be called many different things. It can be called salary, compensation, commission, bonus, or benefits. Okay. So, they have here Ryan Park was hired to work for Smart Touch Learning, and Ryan earns $15 per hour for straight 40 hours. The company pays time and a half, which they are legally required to do that. Here is my plug to make sure that all of y'all are getting paid the way you're supposed to get paid. If you work over 40 hours, you're an hourly wage employee. You work over 40 hours, you're supposed to get time and a half. Okay. I have heard some students tell me that their crooked bosses would do this to them. They'd make them work 60 hours here and then 20 hours here. And then they would tell them, oh, but you didn't work over 80 hours for the 2 weeks, so you don't get overtime. That's illegal. Okay. That is not how that works. You should get paid regular 40 here, overtime 20, and then 20 regular. Okay. So don't let employers do that to you. Usually, when I'm teaching legal environment of business, I'll be teaching this, and I will always have a student say, oh, but my previous boss didn't pay me that way. So, here's my plug for you to be educated and make sure you get what is owed to you. Okay. So, what did Ryan work? Ryan worked 2 hours over. So he got paid for the 40. So the 40 hours times 15 is the 600. And then the time and a half was 22.50. So he worked 2 hours at that. So that gave him 45. Okay. So 645 is his gross earnings. Okay. So let's talk about the difference between gross and net pay. This always happens when teenagers get their first little part-time job and they're like, who in the world is FICA and why are they taking so much of my money? Okay, there's a big difference between net pay, what you take home, and your gross pay. I mean, I was blindsided by it when I started working in high school at the Sonic Drive-In. I was like, they just took all my money. Like I kind of thought, I kind of knew there was this thing called taxes, but I didn't think they'd take that much of it. Okay. And they do. They take a lot just in taxes. Okay. So let's talk about some of the deduction payroll withholding deductions. Some that are required. These are most important, okay, because they are required by law. A company has to withhold them and pay them on your behalf to the government, whatever governmental institution that is. So we have our federal and our state income taxes. Here in Arkansas, we do have a federal. Well, every state has a federal. We have a state income tax. There are states that do not have state income tax. I believe Texas and like Alaska, they do not have any state income tax. But here in Arkansas, we do. Some cities have an income tax, like New York City has a federal, a state, and a city income tax. Why it's kind of expensive to live in New York City. And then we have our Social Security tax. We call that FICA. Okay. There are two broad sections of FICA. There's OASDI, that's sometimes called your Social Security. It stands for Old Age Survivors Disability Insurance. Okay. The other one is health insurance. That is your Medicare that you're paying in. Okay. Other optional deductions, you can have insurance premiums, retirement plan contributions, and charitable contributions all taken out of your check. Okay. All right. The income tax deducted from the gross pay, it's called an income tax. They kind of go through here. This depends, and this is grossly simplified. I think I mentioned it in the last video. If you are an accounting major, you will get into individual tax, and we will talk about how many deductions you can have and all of these filing statuses. You could be unmarried and only have one dependent. You could be a married couple, only have two if you don't have any kids. Married couple with one child would claim three. Okay. Here they give you this W-4. This is a little withholding sheet that you fill out. You've probably seen this before. And you can see where they have the little box right here checked, married, and it says they have three dependents. My husband and I, like the first year we were married, we ended up owing some state Arkansas tax. And that's really hard to come by. Like, so I realize it's probably not the best way, but ever since we got after that, we always, every time we start a job, new job, we always go in here and we mark single. Okay. Why do we mark single? Because the problem is when you're married, you I've got my earnings, husband has his earnings. When they go together, we get bumped up into a higher tax bracket, and then they don't hold out enough taxes on you. You would think by checking the married box that they would hold enough out, but they usually don't. Okay. We also do single and we do zero right here because even though we still have three dependents, we do zero because that makes the most money come out of our check every single week, every month we get paid. So then when we do our tax return at the end of the year, most of the time we're going to get money back. And I have heard people tell me that I can't use the IRS as my savings account, but yes, I can. So it's just so I just don't miss that little bit that's coming out of my check every week, month, or whatever. But if I'm gonna have to pay $2,000 or $3,000 in the spring of every year, that's gonna hit me hard. I'm probably not gonna have that much money. So I just do it that way. That is personal preference. You do not have to actually do it that way. Okay. So, but that you've probably seen that before. Okay. I've already mentioned FICA, Old Age Survivors and Disability Insurance, and the Medicare. And these have different amounts that go with them. Okay. They have amounts right here, but I actually Googled this just a few minutes before I started this video. There are limits. I'm going to come back up here. on this old age survivors and disability insurance. So if you make $176,100, there is actually a cap on the OASDI. You only pay OASDI up to this amount, and that is 6.2%. Okay. There's no cap on the Medicare, but it is 1.45. Okay, 1.45 and 6.2, because most of us aren't making over $176,100 a year. So most of us are going to have to pay all of this. So those two taxes added together is 7.65%. Okay, that's just the employee side. Okay, the employer has to match this dollar for dollar. So multiply that times two, and that's 15.3% just right off the top of your earnings. That doesn't count federal or state income tax. It's really FICA that takes a huge chunk of your money out of your check, and a huge chunk of money from the employer. Okay. I've had a lot of students in the last 22 years say things like, "Oh, I want to be self-employed because I can make less money." That is absolutely not true, because once you become self-employed, you are the employer and the employee. So you owe 15.3% right off the top of your earnings. So you need to make more money when you are self-employed, okay? Because you don't realize that your employer is also matching every bit of these FICA dollars, dollar for dollar, of what you are paying, okay? So they give us an example here. Assume that James Collin, another employee of Smart Touch Learning, earned $142,700 prior to December. Cohen's salary for December was $10,000. Cohen's FICA tax withheld from his check is calculated as follows. Okay. So earnings, employee earnings subject to tax, 147,000. They're going to take out the prior month 142. So that is current pay subject to tax, 4,300. And I'm not going to make you memorize these ratios or these caps, okay? Because I think they're using a different cap here than the one I showed you. All right. So 4,300 multiplied times that tax rate, 6.2%, got us $267. Okay. There is no max on Medicare, so the entire amount is going to be taxed at the 1.45%. So that totals $412. Okay, right. Some companies offer benefits, and most of that is a lot of times that would be health insurance for you and your family, retirement savings. Let me just say, if your employer is matching anything on retirement, you had better make sure that you are putting in what you can to max out what your employer is going to contribute to your retirement, because that a lot of times that's what happened. They'll say, "Hey, if you put 6% in, we'll put 6% in." That's a raise right there without having to do anything, okay? Just for saving money, okay? Union dues, I think unions are a little bit outdated. We have a lot of government oversight now. I don't know that we need too many unions. There might be a couple of professions that need unions, but for the majority, we have lots of government oversight now. We did not have, like in the early 1900s, the Industrial Revolution, we did not have a lot of government oversight. So we probably did need unions back then. Gifts to charity, you at CBC, I can say, hey, you can withhold so much money out of my check, and we I think we sometimes donate to United Way of Faulkner County, because United Way of Faulkner County does not fund any abortions, so it's a good one for it's a good CBC deduction. So I know we've done that in the past. I don't know if we're doing that anymore. Okay. All right. So now we're going to look at this James Cohen's final pay period of December 31, assume that he authorized a $180 payment for health insurance, $20 contribution to United Way. The employee income tax is assumed to be 20% at gross. That is very grossly simplified. That is not how they calculate income tax, but for purposes here, that is fine. Okay. So gross pay, we have is income tax, OASDI, Medicare, health insurance, contribution to United Way. Okay, there is a big difference between the gross pay and the net pay. Okay, this is where you start. That's however many hours you work times whatever hourly wage you have. And then this is what you're going to take home. You can see he looks like he's making really good money. I mean, he is making good money if this is just for a week or 2 weeks. But there's a big chunk. Like, look at that, $2,600 just in other things that are going out. Okay. That's not coming into the employee's pocket. All right. Um, we have an employee register. This kind of helps us summarize earnings, withholdings, net pay for each employee. So you can see here we have all these different employees, their current period earnings, ending cumulative earnings. This would be a really good Excel project right here. You can see the OASDI, Medicare, income tax, health insurance, charity fund, total withholdings, net pay, check number. Oh, they don't really actually do many check number, actually writing checks out these days. Most everything now is automatically deposited into your checking account. And if you're not doing that, you're missing out on getting your money just a little bit early. So electronic funds transfer is a great thing. Okay. So that's the payroll register. Now we're going to look at the journal entry. Okay. All these numbers came from right up here. Okay. Where's that? There we go. That right there. OASDI 1419. Okay. All of those numbers came in here. Okay. Here's the gross. Sorry about that. That's the gross, and here's the net. They got that from that employee register up there. All these numbers were already calculated. And notice that all of these things are being credited to a payable because the employer is going to remit those funds to whoever they're supposed to. Okay. These three usually go to the exact same place. It's one check. The employee health insurance payable, that's going to go to a different place, United Way. And then what they're actually going to pay, this net will actually just be paid out, a check written or electronic funds transfer. Okay. So here, whenever that either the checks are written or the electronic funds transfer takes place, they'll debit that payable and credit cash for that amount, that net amount. Okay. All right. So now let's talk about the employer side. I've already mentioned that FICA, OASDI, and Medicare is matched by the employer. So the employer has some taxes that they have to pay that you're not even seeing on your check register. That's why it's very expensive to employ people. Okay. So anytime a business is doing good and it's employing people, that's a good thing. Okay. Because they're making money, they're paying tax. Okay. We have two other taxes. There are some states that actually push some of this off onto the employee. Arkansas is not one of them. So we have the SUTA, State Unemployment Compensation Tax, and FUTA. The FUTA and the SUTA. They're not very expensive taxes, but I don't see, yeah, yes, there's some numbers on these. So here they have. This was a distribution of payroll for an employee who earns $1,000, assuming the employee has not reached any payroll limits. Okay. So the employee side, they have their net pay, they have the OASDI and Medicare and income tax. Okay. OASDI, again, on the employer side, they got to match that. They got to match the Medicare and they have to pay the FUTA and the SUTA. So the FUTA is 0.6% on the first $7,000. The state is 5.4% on the first $7,000. This number actually change and it will vary from state to state. And if you're a business that never lays anybody off and you don't have a lot of unemployment claims against you, sometimes that percentage can get decreased down. Okay. All right. And so here we have that for all of the employees now. This is the employer side. The one we did earlier was the employee. Now we have the match of the OASDI and Medicare. Then we have the FUTA and the SUTA. And then we have a journal entry. Payroll tax expense. These are all those things, that OASDI that we had to match, Medicare that we had to match. Then the FUTA. Notice that's not a really big tax, and it caps out at $7,000. So after that employee's made $7,000, then they don't have to pay any other unemployment taxes. Okay. All right. And then when it's all said and done, that employer is going to have to remit all of those funds, all of those. These aren't going to all go to the same place. That's why I don't really like this all being in one entry, because this looks like one check was written to all of these. I promise you they're writing a different check to United Way than they are to FICA and the income taxes payable. Okay, this is where they're paying all that. Notice that these two were doubled because we had the employer and the employee side. Okay. All right. The last little bit of this section is internal control over payroll. Payroll being automated rather than prepared by hand is a really good control of payroll. Employees signing checks and they have to present their IDs to pick up their checks. The hotel that I worked at when I was young, like 19 years old, our boss would clip our paycheck to our time card. And then, somebody's check got stolen one day. And I was like, that didn't seem like a really good internal control. And I was only 19 years old. Hadn't even taken my first accounting class in college yet. And I was like, that don't seem good because I could have just grabbed anybody's check. And my brain kind of goes there sometimes on thinking really skeptical things. Okay. Hiring and firing should be separate from the payroll preparation. Time clocks and direct deposit are also used to help control payroll. Remember those functions. I mentioned those back in the previous chapter. We had that ARC, authorization, recording, and custody. And so that's kind of why the hiring and the firing, that's an authorization issue separated from the payroll preparation, which is a recording function. So you remember, we don't want to cross those functions because that would, leave room for somebody because, hey, they could just authorize a fake employee and send themselves a check. Okay, so you can kind of see where my skeptical brain goes. All right, that's all for this section. We'll pick up on objective 11.3 in the next video.